This is chapter 1 and this is the first video for this course. I'm not covering everything that's in the book. You should read the theory in the book. You should read the chapter carefully, follow the examples. What I'm going to do in my videos is to pull out the important information, the most important examples, and just give you some insight into where the numbers come from. So for this chapter, we're going to be accounting for investments. The fair value method is used for investments where the investor does not have significant influence, doesn't really have enough people on the board of directors to make a difference in the direction that the board of directors wants to go. And that's generally less than 20% ownership. The equity method is used for investments where the investor has the ability to exercise significant influence. And that's generally between 20 and 50% of the voting stock, because now they'll have between 20 and 50% of their own people on the board of directors. These two methods you learned in 335, in Intermediate 2. On January 1st, 2020, for example, Big paid $210,000 for 20% of the voting stock of Little. Assume that 210 is the fair value on that date. So we have the fair value given in this example went up to 245, 282, and then 325 over the years. Always keep in mind the percentages. Sometimes your book will give you the 20% or whatever the ownership percentage is. Sometimes they'll give you 100%. You have to be aware of this. So what I did was gave you the calculated 100% fair value. I don't believe this is in the book. I simply took the 245 and divided it by 20%. I think that I put the formula here in the formula bar. You should download the Excel spreadsheet that I've posted with chapter 1. When you do that and you save it onto your own computer, you will see things like the formulas that I've put in. Okay, so that's 100% value. I just did it to show you. You were given in the example the fair value of 20% of Little, but then they gave you 100% of the income and 100% of the dividends. Big doesn't own or get these numbers. Big only gets the 20%. All right, but for the moment, let's assume that Big does not have significant influence, that the fair value method is used, and Big reports dividends from Little as dividend income, because that's how fair value works, and they report the annual change in the fair value of Little as investment income. From 335, you may remember that this is shown on the income statement as an unrealized gain or loss. Using the investment income account is just expedient for this discussion. It just makes the discussion simpler, and it's less awkward than using unrealized gain or loss to be shown on the income statement. Okay, so based on what we know, if there's $50,000 in dividends and we own 20%, then 10%, $10,000 is our share of the dividends. When they declare the dividends, we have dividends receivable, we have dividend income. When they pay the dividends, we get cash and we get rid of the receivable. Investment in Little at year end, when the fair value went from 210 initially to 245 at the year end, we've had an increase of $35,000. So we debited the investment in Little and we credited investment income. So what we've got is that we started at 210, we increased our investment by 35, and at year end, our investment is 245, and that does represent 20% of the fair value of the company. Now, if instead we use the equity method, then we have control over the company. We decide dividend policy. We hopefully contribute to why the company has income. And therefore, if we pay ourselves dividends, we can't call that income because we're controlling our own income. We're managing our income. You could say manipulating, but managing is the term that's used. So when there's income, it decreases our investment because it decreases the retained earnings of the company. When the retained earnings go up with income, that increases our investment. So when we have the same situation now, what we have to do is say, all right, when we get dividends receivable, our investment in Little goes down. Doesn't matter that we get cash. I just put this in because obviously we do declaration and then payment or receipt of payment. And the investment in Little goes up by the amount of the income, our share of the income in the other company's equity. So this is the dividend received and the equity that we have in Little's income. I don't remember what Little's income was, but it was $200,000. We have 20%, so $40,000. And that gives us carrying value of $240,000 as opposed to the fair value of $245,000.